moving to thing number two, again, we said we're talking Fed rate cuts. Fed rate cuts were supposed to improve housing affordability. Thing number two, Gary, exactly that. Fed rate cuts were supposed to improve housing affordability. And I'm guessing you're going to tell me that they haven't.
Yeah, they have not. So, Rob, let's actually go to the basics. And let's just explain things in the most basic way possible. When people go to buy a home, they can afford a certain monthly payment. Now, does it really matter to those people whether that payment goes to principal or to interest? Yeah, it matters a little bit. I mean, it's obviously you'd prefer to be paying less interest and paying down your mortgage, but people mostly go off of the payment. And so that payment will be made up of your interest expense and your principal payment, paying down the value of the loan. And so, when people say, I can afford a certain amount and interest rates go up, the way they have to match that is to pay less for the home. Well, that hasn't happened. So back in September, the Fed started cutting. And between September and December, the Fed reduced the Fed funds rate by 100 basis points or 1%, which, believe it or not, is a lot. Now, I'm going to tell you that DKI spent all of 2022, 2023, and 2024 telling the Fed, telling everybody, do not cut rates, do not cut rates, do not cut rates. It's going to lead to more inflation. And well, guess what? The Fed cut rates, and ostensibly what they were saying is we want to improve the economy by lowering people's borrowing rates. And they also wanted to reduce people's mortgage payments, saying, hey, we're going to make housing more affordable. If we lower rates, then the interest portion of people's mortgage payments will be lower, and that will lower their monthly payment. And that would make sense, except what happened was the bond market, who are not, the bond market tends to be very smart. And the bond market said, wait a minute, the Fed is lowering rates, we're projecting more inflation. And instead of mortgage rates coming down, the yield on the 10-year security actually rose by 100 basis points. So instead of doing this, everything went like this. And again, that created a problem. And so the 30-year fixed rate mortgage is now above 7%. Now, just to give you a sense, when I refinanced my mortgage in late 2021, you could refinance right around 3%. There were people at, 2 7/8, 3 1/4, but right around 3%. And so what we have seen is that housing prices are up, rental prices are up, mortgage rates are up, and that has all happened into a housing market that was horribly unaffordable for most Americans. So, as we put it in the written version of the 5 things, what could go wrong?
Yeah, Gary, we just recently released one of our older ebooks. We obviously made some updates, but takeaway in this week's 5 things, we're talking about the ebook a couple of years ago, about a year ago, Counterintuitive Inflation, explaining kind of the phenomenon, what's happening. I feel like we're just going to be re-releasing all of our work over and over as we get closer to these events that you've called out so early on. But Gary, tell us more about that and why the Fed is just stuck or trapped.
Yeah, thanks, Rob. So, by the way, for anybody who missed it, that ebook called Counterintuitive Inflation, we released it over a year ago, and it actually did predict what happened and explains what's going on. If you want a copy of it, we have given it away for free. We've put it out in public. Just shoot an email to ir@deepknowledgeinvesting.com, and I'll send you a link. I read everything that comes into that email address, and I'll send you a link, and you can download it for free. But basically, the way things used to work is the Federal Reserve would, raise rates when they wanted to slow the economy. They would lower rates when they wanted to add a little more fuel to the economy. The problem here is we've had so much overspending out of Washington that the Fed no longer has as much control or impact as they would have had just a couple of years ago. And the reason for that is it's not the Federal Reserve that's creating inflation right now. Now, they haven't helped. They have made things worse. But the real reason for the increase in inflation is trillions of dollars of excess spending out of Washington, D.C. Now, for the partisans in the crowd, this is a bipartisan problem. Republicans spend too much. Democrats spend too much. It's a problem all the way around. But because Congress won't stop overspending, what will happen is with the official debt right now, about $37 trillion, and the outgoing Treasury Secretary, Janet Yellen, she reduced the duration of the Treasury bond portfolio. Now, that's just a fancy way of saying that when the government over the last couple of years had to refinance, instead of refinancing with 10 or 20 or 30-year paper, they refinance with a lot of 6-month and 1-year and 2-year paper. And what that means is all of that debt is going to have to be refinanced more often. And so as that debt rolls over and 1 or 2% debt is replaced by 4 or 5% debt, it increases the interest expense that Washington has to pay. Now that's well over $1 trillion a year. Well, if the government is overspending and we need to pay more interest, how do we do it? Well, the answer is they roll the debt and they print more dollars. Well, guess what? It was dollar printing that created this inflation problem to begin with. And that's why the Fed doesn't have control. If the Fed increases interest rates to try to get inflation under control, all that means is that Congress and the Treasury are going to need to create more dollars to pay a higher interest expense. This is something that we've called counterintuitive inflation. Lynn Alden, who I respect a lot, has called it fiscal dominance. But the Fed has lost control of all of this, and the answer is nobody panic. Nobody. I mean, we can get upset about it, but it won't help. The answer to this is prepare your portfolio for more inflation. It is on the way. There is nothing they can do to stop it. It is baked into the system now. And, for people who are having difficulty or saying, wait, I don't know how to do it, guess what? This is what we do all day, every day. So, feel free to reach out to Deep Knowledge Investing. We are helping people deal with this problem right now. And I will just remind you that you don't have to lose value. There are things you can do in your portfolio to not only survive this, but to take advantage of it and make money from it.
Yeah, great stuff there, Gary. And again, if you'd like a copy, ir@deepknowledgeinvesting.com. We'll be managing that inbox and be sure to get you any of that material that you might be looking for on the counterintuitive ebook that we wrote about a year ago. This is this week's version of the 5 things, the currency and debt problem issue. I'm here with Gary Brode. Please head to our website, deepknowledgeinvesting.com. Sign up for a free subscription. We'd also love if you considered a premium subscription to allow us to continue to bring you high quality content and information on what's happening in the market on a week-to-week basis.